FX. In the high-stakes world of professional financial markets, the difference between consistent outcomes and random results lies in a deep understanding of market mechanics and institutional order flow. Today, we are conducting an exhaustive, in-depth case study of the trading week spanning April 6th to April 10th, 2026. This was a week characterized by significant structural shifts, massive liquidity sweeps, and high-impact price movements that provided incredible opportunities for those who know how to follow the institutional footprint. Throughout this week, our research desk monitored 9 distinct assets that form the core of our institutional portfolio: gold, silver, WTI crude oil, NAS 100, SPX 500, US 30, GBP USD, AUD USD, and BTC USD and BTC USD. By utilizing our specialized smart money concepts, SMC logic, validated by the Alpha Hybrid Intelligence (AHI) framework, we mapped out critical liquidity zones and identified supply-demand imbalances long before the retail crowd even realized a move was beginning. The result of this disciplined, research-heavy approach was undeniable. Our shared scenarios maintained a remarkable 80% accuracy across all 9 assets. In this video, we are going to decode the specific institutional reasoning behind the parabolic move in gold that shattered major psychological barriers, the calculated distribution and massive sell-off we forecasted in WTI crude oil, and the resilient bullish structures observed across the global indices. This is not just a simple weekly recap, it is a masterclass in market psychology, institutional flow, and capital preservation. To truly appreciate how we achieved an 80% success rate, we must look at the strategic roadmap we followed each day. In the world of must-profit FX, consistency is the hallmark of professional research. On April 6th, we initiated the week by focusing on core volatility in gold, GBP USD, silver, and NAS 100. Our primary goal was to identify the weekly opening range and the immediate liquidity sweep zones that market makers target during the transition from the London to the New York sessions. By identifying these early traps, we were able to set the tone for the entire week. April 7th was undoubtedly our most intensive research day. We released comprehensive institutional outlooks for a wide array of assets including AUD USD, GBP USD, silver, gold, US 30, BTC USD, and WTI. It was on this specific day that our AHI system identified the heavy institutional supply sitting above the WTI market and the bullish consolidation phase forming in gold. This foresight allowed us to prepare for the massive expansion moves that followed. On April 8th, our focus shifted toward the global indices and precious metals. We tracked silver, gold, NAS 100, and SPX 500 as they approached our predefined points of interest. Using SMC logic, we looked for change of character signals on lower timeframes to validate our higher timeframe biases. This multi-timeframe alignment is what allows for high-precision entries with minimal exposure. As the week progressed into April 9th, we updated the momentum on WTI, AUD USD, gold, NAS 100, and Bitcoin. Our focus remained on ensuring that our scenarios remained valid amidst midweek volatility and managing the profit-taking expectations for our research community. We concluded the week on April 10th by managing expectations for the Friday close, emphasizing the importance of closing out historical observations and mitigating the risks associated with weekend gaps and liquidity thinness. Let's dive into the specifics of the assets. Our primary focus for gold was the psychological and institutional barrier at 4,800. In our shared research, our directive was explicitly clear: if it breaks 4,800. In institutional trading, a level like 4,800 isn't just a number on a screen. It is a liquidity ceiling where massive sell orders are often clustered by retail traders and smaller institutions. Once the market cleared the buy-side liquidity sitting above 4,800, it created a vacuum. This institutional vacuum pulled the price directly toward the 5,000 handle. The move was not random. It was a textbook break of structure on the daily time frame, followed by a successful institutional retest of the demand zone. Silver showed a perfect correlation to this move. While retail sentiment was looking for a reversal, our SMC-based mapping identified that the 76.00 break was a high-probability expansion phase. Silver moved aggressively, hitting our historical observations of 80.00 and 82.00. The logic was simple. Institutional demand exceeded available supply at our point of interest, leading to a parabolic expansion. The most significant move of the week occurred in WTI crude oil on April 7th. We had identified a massive supply zone at the 104.00 level. Using smart money concepts, we observed a classic distribution phase where the market was unable to create a new high, signaling that big players were offloading their positions to unsuspecting buyers. As soon as the internal liquidity was swept and the market broke its immediate support, WTI commenced what we called the big fall. Our bearish scenario targeted the 84.00 demand zone. The price action followed our mapped trajectory with nearly 100% precision. This move alone highlighted the power of identifying where big money exits positions. When institutions distribute their holdings, the resulting momentum is often too strong for retail traders to fight. By staying patient and waiting for the market to tap into our supply zone, we saw the scenario align perfectly for a massive aggregate outcome. Turning our attention to the equity markets, on April 7th and 8th, the global indices showed incredible resilience and bullish intent. While mainstream media was often focused on macroeconomic uncertainty and fear-mongering, the technical charts of NAS 100 and SPX 500 were showing clear institutional accumulation. For NAS 100, we identified a primary point of interest just below the 25,000 level. The market dipped into this zone during the New York Open, trapped the early sellers in a classic liquidity grab, and then rallied with immense force. Once the daily candle closed above 25,000, our bullish bias was fully aligned. The US 30 and SPX 500 followed this lead, proving that the indices were in a controlled institutional markup phase. Understanding that indices are designed to go up over the long term, we simply waited for the smart money to show their hand at our demand levels. In the Forex space, GBP USD and AUD USD provided excellent pullback opportunities. For AUD USD, our scenario hinged on the 0.7100 resistance level. When the price failed to sustain momentum above this level, it initiated a pullback toward our 0.68800 demand zone. This wasn't a reversal of the overall trend, but a necessary rebalancing of the market to pick up more buy orders. Bitcoin also remained a key asset in our portfolio this week. By tracking liquidity sweeps on the 4-hour timeframe, we were able to navigate the volatility on April 7th and 9th. We observed institutional interest returning every time the price dipped into our designated demand zones, ensuring our historical observations remained accurate despite the rapid price swings inherent in the crypto market. At Must Profit FX, we do not just share random signals or targets, we share institutional scenarios. This week, our success rate stood at 80%. This level of consistency is the result of 15 years of market experience and a commitment to pure SMC logic. However, accuracy is nothing without a disciplined risk philosophy. Our guiding principle is always rule number 1: protect your capital. In cases where a scenario did not align, which we refer to as an invalid outcome, our structural logic ensured that the risk was mitigated. We utilize neutral, compliance-friendly terminology, such as aligned, invalid, and historical observations, to remain consistent with global regulatory frameworks. This disciplined approach is what separates Must Profit FX from the retail noise. We focus on the aggregate simulated outcome, rather than individual emotional results. We believe in high probability trading, which means waiting for the market to come to us, rather than chasing the market. As we close the book on the week of April 6th to 10th, the data is undeniable. Institutional logic and liquidity mapping win every time. Whether it was the rally in gold to the 5,000 mark, the collapse of WTI to 84, or the steady climb of the NAS 100, our framework provided the clarity needed to navigate these complex markets with confidence. For those looking to dive deeper into these case studies and see the actual chart markups, our full weekly research logs are available on our official portal at link-to-mustprofitfx.com. We invite you to study these charts, understand the points of interest, and see for yourself how the smart money moves. Trading is a marathon, not a sprint. Success comes to those who wait for their scenarios to align and prioritize capital preservation above all else. We are already processing the data for the coming week, mapping out the next set of liquidity zones and institutional points of interest using our AHI system. Make sure to stay connected with us on all our social platforms, LinkedIn, X, Pinterest, and YouTube, to receive these insights in real time. If you found this case study valuable and it helped you see the market through a different lens, please like the video and subscribe to the Must Profit FX channel for more institutional-grade market research. Until next time, trade with logic, stay disciplined, and always protect your capital. Happy trading to everyone from the Must Profit FX team.